This week sees a raft of key data points coming out of the UK, coming at a difficult time for both the Bank of England and the government. They would like to stimulate, but of course there's a risk when it comes to the UK government. It comes down to borrowing levels. When it comes to the Bank of England, it comes down to inflation. But the GDP and jobs data released over the course of this week will tell markets a lot about the state of play and what we can expect from policy going forward. So first and foremost, we can see here that this is the outlook for data over the course of the week. Essentially, it's a Tuesday and Thursday affair. So Tuesday, we've got the jobs report expectation. We see flat average earnings, flat unemployment, a decline in terms of the employment change figure, a decline in terms of the claimant count figure. Then looking towards Thursday, GDP is really the key one, and we're expecting to see a return to expansion, 0.1 expected for the month of June. Beyond that, you can see that we also have the quarterly figure. So 0.1 expected for the quarterly figure. The annual figure of 0.7 really tells you everything you need to know at the moment about the UK economy. And then we have the likes of industrial production, manufacturing production, and more, the back end of the list. But ultimately, it takes place over Tuesday or Thursday, and both largely exactly the same time, right? So 7 a.m. UK time. This is a UTC time, so it's just easier for people to translate it to the time zone that they're in when watching this video. But certainly this is a difficult one because, yes, we've seen the Bank of England cut interest rates, but essentially it was a 4-4-1 vote. They had to re-vote, and essentially they got there in the end. They got the rate cut, but it was paper thin. And so the expectations for the next meeting has pretty much gone out the window. Right now, we've got near enough 92% chance that we see rates on hold. Then you look at November, expectations that we see the same. Then you see the next cut potentially happening in December. That's a 60% chance. But bear in mind that even that comes with it a lot of uncertainty, because where the economy is going to be at that point, we don't know. We would have seen the budget from Rachel Reeves by then. So a lot would have changed by that point. So inflation in particular will be a key thing that could be holding back the Bank of England even through the back end of the year. So right now, markets are pricing the next rate cut as happening in December. And if you look beyond that, you're seeing pretty much nothing, right? So there's like a 50% chance that we see one more cut for the remainder of the next year. So essentially 2026, one single cut, and that's a 50% chance. This doesn't mean that that's what's going to happen. It just means that there's a huge amount of uncertainty at the moment around exactly what the position is going to be for the UK. Will they manage to bring inflation under control? Will we see the government coming out with stimulus packages that ultimately take some of the pressure off the Bank of England? Seems unlikely given the current fiscal position that Rachel Reeves is in. Different questions will emerge. Certainly the stability and direction of the economy as a whole, as highlighted by GDP, and then the jobs market. That's going to be key in terms of how much pressure the likes of the Bank of England in particular have upon them to take action. The jobs market has been shown deterioration recently. You can see with the blue line, they increase in terms of the unemployment rate. It's not necessarily massively elevated compared to some of the peers, but certainly it's heading in the wrong direction very clearly. And then you can see in terms of the claimant count figure, that has been on the rise. 2 positive readings in a row now. So this time around, we're expecting to see, here we go, the claimant count figure coming in at 15K. So another positive reading expected, although a decline from the prior month. At the moment, we've been talking a lot about this idea of a 20 to 30 billion pound black hole that Rachel Reeves is going to have to fill, and that will come in the autumn statement. And by and large, it's going to come through a series of tax hikes and way to take more money rather than significant spending cuts. But in actual fact, a lot of this really emerged from the fact that they had welfare reforms that were going to cut their spending on welfare, but instead that just fell by the wayside. They ultimately bowed to pressure, and that created the black hole that they needed to fix with taxation. So part of that is also down to the fact that when you have a huge amount of debt, or when you're borrowing, you need to keep borrowing costs under control. That hasn't been the case. We've been seeing the 10-year yield that we see here elevated for the UK. What's notable here that when we're looking at the 10-year, essentially you're looking at the relationships between countries and their central bank rates as well. The 2-year highlights it better than the 10-year, but certainly when you're looking at sort of medium term borrowing rates, you can see the 10-year is the sort of key midpoint. You know, a lot of the time when you're looking further out, you're looking more like 30 years. When you're looking at something short term that really is reactive to what the central bank's doing, you're looking at the 2-year. So the 10-year is sort of a middle ground to sort of try and encapsulate everything. And what's noticeable here is that the countries that have got elevated levels in terms of the 10-year are the countries that have been very slow to ease. So you can see here the UK, New Zealand, the US, Australia. New Zealand sort of an outlier there because they have eased a decent amount. But below that, you can see Canada and the European rates significantly lower. So it does highlight the role played by the central banks when it comes to driving down borrowing costs, and that eases the pressure on the public purse. It means that when you see bonds rolling over and being reissued, they're not done so at a really high rate, which means that you're just taking on more and more debt. Now, of course, essentially, it comes down to whether the Bank of England actually feels like they can take action or not, or whether their hands forced. So can take action or not will come down to the inflation side of the picture. Do we see inflation come lower? Well, UK inflation, the highest of any G7 nation. Then you see the other side of the picture, which is economic deterioration and weakness, that they essentially have to take action and they're willing to overlook the inflation side of the picture. It generally would take a fair amount for that to be the case. Recently, we did just see this rate cut in the face of rising inflation, but that might not necessarily be the norm. Now, if we're looking here in terms of, this is not 10 years, this is the monthly GDP rate, you can see we're coming off the back of 2 consecutive monthly declines in terms of UK GDP. That puts pressure on the UK finance as well, because it means that essentially they're receiving less in terms of tax receipts, they're paying more in terms of benefits and welfare payments and the like. And so we really need to see positive GDP, because the assumptions that the budget was originally based upon were born out of the idea that we're going to see, you know, not huge GDP numbers, but better than we're seeing at the moment. So if we see suddenly a big pop in terms of GDP, all of a sudden it creates that headroom. That 51 billion pound figure starts to shrink, right? So it's really going to be quite dynamic, this sort of movement in terms of that black hole figure, and it leads us into understanding exactly what the government can do or can't do, what they're going to have to do, how much cutting they're going to have to do, how much tax hikes they're going to have to do, and alike. So the GDP figure is going to be really key. The jobs data is going to be really key. All of it really feeds into how much pressure there will be on the Bank of England to act, but also by how much are we going to see the government take action that will be by and large negative for the UK economy. If you raise taxes, irrespective of where you find it across the board, it's unlikely to spur innovation and spur investment and the like. And we have been seeing a record number of millionaires leaving the UK of late. So the more you sort of tax the rich, the more you see people leave, and therefore those are the major net contributors to the UK's finances. On the flip side, if they were to suddenly try and raise taxes that hurt the sort of poorest in the country, that again is going to really hurt them in the polls. So the government really in a fairly difficult position. You would say in the past, well, just tax the big tech companies that are coming over here earning billions and repatriating those earnings elsewhere. Well, Donald Trump seems to be a pretty difficult person to deal with. And I think if anyone was to do that, you're suddenly going to get a backlash from the likes of Donald Trump and the US. So let's look at this in terms of the context of what it could mean and how it could play out for the likes of the FTSE 100 and then cable. We'll kick off first and foremost with the FTSE, and we can see, there we go. So this is the FTSE 100 on the 4-hour time frame. Let's look from a wider context first and foremost, just to give us some clarity over exactly where we are within this trend. So very clearly we have periods of long-standing consolidation, but then we have pretty decent breakout periods. We're within this very bullish phase at the moment. There is a perception that the UK is in a relatively decent position given the more advantageous trade agreement that we got with the US compared to some of our neighbors and some other countries around the world. Will that make UK businesses that little bit more competitive, that 5% more competitive in terms of selling to the US? Perhaps, but of course, less competitive against US businesses that aren't paying those tariffs. In terms of the direction of travel, part of this also comes down to the kind of components that are found within the index. That's heavily weighted towards financials. So, of course, elevated interest rates remain a positive for those kind of stocks. And then you're looking at the likes of commodity stocks in particular. And so really the sort of global outlook for economic activity is key there, because, of course, if we think that the world is going to suddenly see a big boost in terms of growth, which has by and large been the case recently with trade deals being struck, people are feeling a lot more confident, then that sort of pushes prices for different metals and materials higher, which benefit the mining companies that take it out the ground. So these are the kind of things that have been helping things along the way for the FTSE 100. But nonetheless, if we're looking at sort of short-term price action, we know that we're set within a bullish trend. We know that essentially we're trading within this zone here, right? So the top end is like there, the bottom end is roughly there, right? And so we know that recently we've pulled back into this zone of support, and now we're rising once again. Now, if we're looking at this level here, this is the neckline on a double bottom formation. And crucially, the fact that the matter is that we have created this tentative higher low. So you've got a double bottom around support, this support zone, with the break up through this 91.25 level, completing the double bottom and pointing towards a return towards the top end of this range. So this to me looks bullish, irrespective of how the data is going to play out. It's quite difficult to really know exactly how markets are going to react to this data from the perspective of the FTSE 100, because on one side you could see economic weakness, let's say a weak GDP number remaining in negative territory, or a jump in terms of unemployment. On one side, UK businesses should be fearful because they're operating within that environment, and it says a lot about the lack of economic strength within the UK economy. The flip side of it is, well, great, we're going to see additional rate cuts from the Bank of England, and therefore we should feel positive about the loosening of the sort of monetary strings, so to speak. So I would probably rely a little bit more on the technicals on this front. If we break out from this wider range, then we ignore the range, right? We start to then trade the exit of that range. Until that happens, expect more of the same. And it looks to me like we're potentially bottoming out here for a potential move back up to your sort of 91.70 mark for the FTSE 100 if we break that neckline. And then you've got cable. So cable has been on the rise, you can see here, really gaining strength off the back of that weakness that we've seen for the US dollar. But the US dollar has been coming into a little bit of strength recently, in part because of the trade deals that have come across the line under Donald Trump. And so we started to see this reversing. So what's interesting here is we've rebounded over the course of the past week, but we've come into this 76.4 fib. You can see here this sort of head and shoulders formation here with the neckline now broken. And so this rally that we're seeing at the moment, to me, this looks like a potential trend reversal from a wider perspective. I'm just trying to grab as many of these, just move it up there, grab as many of these lows as possible. There we go. Well, we can see we've got those extremes, but we've got the 3 points there. So to me, it does look like we've sort of broken out from a trend for the near term. I wouldn't be surprised to see it rolling over once again. But the fact of the matter is, if we break this sort of 1.358 level, 1.359, then that's negated. The trend comes back into play. But until that happens, this 76.4 looks really interesting for me. 1.348 essentially. We're starting to weaken a little bit from there. Here is the hourly time frame. If we start to sort of break down through your initial swing lows, your first one is kind of already drawn on here, right? 1.34178. If we start to break through those levels, then it starts to look like it's either a wider retracement of this rally or that we've topped out. And certainly given that wider context, I think there's a good chance we do start to see this rolling over. Now, what would happen in terms of the data, or what would be needed to happen in terms of the data to point towards this pair rolling over? Well, it would need to come in relatively weak. So again, weak GDP, maybe in negative territory, weak unemployment, so that or strong unemployment, however you look at it, unemployment rate on the rise, or the claimant count jumps and things like that. You know, we've got industrial production, manufacturing production, a lot to go at. But certainly from a technical perspective, there's a signal to me that we could have rolled over here. And the fact that we've rallied into the 76.4, near enough tagged it and start to weaken, that's a bit of a warning sign that we could see the bears coming back into play. Of course, we also have the fact that, you know, this isn't done in isolation. It's a pair. You're trading against another currency. You're talking about the US dollar, the Federal Reserve looking like they're going to be cutting at each meeting at the back end of this year. Bowman said that over the weekend. She even alluded to a potential 50 basis point cut. So I am aware of the bear story for the US dollar, of course. And certainly if we do break the 1.35886 swing high, then yeah, that bullish trend looks like it's back in play. But for me, this data dump does at least provide the basis for a focus on the UK for the near term at least. And if we're looking at potential drivers of price action for the US dollar, I think the one that's kind of going to be interesting is going to be the US CPI, also released on Tuesday, same as the UK jobs report. And I think that we've perhaps got a little bit overextended on the idea that we're definitely going to see a huge amount of rate cuts at the back end of this year, because the reason they were holding off was not weakness in terms of the jobs numbers and the payrolls, or strength as it may have seemed at the time, which has now turned to weakness. The reasoning was uncertainty over the direction of travel for inflation. That still remains in play. And yes, we haven't seen a huge amount of inflation at the hands of tariffs thus far. That doesn't mean it's not going to come. A lot of the time, these things have a lagging effect. And therefore, if we see inflation kicking in on Tuesday, I won't be surprised to see a bit of a rebound for the likes of the US dollar, and therefore driving the likes of cable lower. So that's how I think we could see this rolling over move starting to being fueled once again, essentially, and seeing cable start to turn towards the downside. So an interesting one. I mean, a huge amount of data. I've already provided a separate video for, well, the week ahead as a whole, which touches on both the topics, but also the US CPI release that's coming tomorrow, with a host of different charts and graphs highlighting exactly how things are shaping up from that perspective. Lots to go at, an interesting time, but certainly the UK economy is in a bit of a difficult spot, with the sort of black hole in the finances, a weak economy, but then strong inflation. It's the worst of both worlds, really. So let's see how this plays out. But certainly at the moment, there's a possibility we could be rolling over for cable once again. And then we have the prospect of the FTSE 100 potentially doing more of the same, right? You know, equity markets still relatively strong despite the question marks. And this is a prime example to say that the stock market is not the economy. That's it for today. Make sure to like, subscribe, follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day.